Hello, good morning or afternoon, depending on where you are in the world. Thank you for joining us. I'm John Basquill. I'm a senior reporter at GTR, and I'm going to be chairing this panel discussion looking at commodity trading in Asia, a risky business. We're speaking during a pretty turbulent time for the commodity trading sector in Asia, and at a time when there are real concerns around the future of commodity finance across the continent, and indeed across the world. A lot of what we'll talk about today stems from the COVID-19 pandemic and the collapse in oil prices in the first few months of this year. But what we're going to focus on is some of the issues we've seen unfolding in Singapore around fraudulent trading activity, company collapses, banks being left out of pocket, and ultimately banks becoming nervous about providing financing to the sector. Company collapse in the commodity trading sector isn't a new thing. Of course, but for the purposes of this conversation, I suppose we're going back to the issues at Agritrade, which started to emerge in late February with accusations of double financing, fake trades, and so on. Then came Hin Leong in April, a shock announcement that the company had hundreds of millions of dollars in undisclosed losses. And we've since learned about a huge network of fraudulent behavior at Hin Leong and associated companies, with forged documents, financing applications for fake trades, multiple financing for the same trades, and essentially an arrangement where the company had to keep finding ways to generate more and more working capital just to pay off earlier debts. Around the same time, similar accusations were made in relation to Zenrock, and other accusations are still being leveled at other trading companies. There are, of course, legal proceedings still ongoing in those cases, and we're not accusing those firms of any wrongdoing ourselves. But one important consequence of all this has been the impact on banks themselves, so beyond just the losses sustained. And probably the most significant announcement we've heard so far has been from ABN AMRO, which suffered huge losses in the Hin Leong case. As you'll probably know, ABN AMRO is planning to close down its entire trade and commodity finance business worldwide over the next few years. Other banks, SocGen, BNP Paribas, are also scaling back or consolidating their commodity finance business, and strategic reviews happening within many other banks, and we're really still waiting to see what the end result will be from those reviews. So I'll stop there and introduce my panelists. A huge thanks from me and the rest of the team at GTR for agreeing to join us in this discussion. We have Baldev Binder, who is Managing Director of Blackstone and Gold law firm. We have Natalia Frolova, an independent finance and insurance expert. Robert Cooper, Regional Director for Political Risk and Structured Credit and Credit Specialties for Asia at Marsh JLT Specialty. And Raj Uttamchandani, Executive Director of Trade Finance Market. So Baldev, I'll start with you if you don't mind. What, in your view, can we take away from those fraud cases and from the bank's responses? How should we be viewing these announcements and these findings?
My view of it, thanks, John. My view of it, I think, is that it's a time for a review, a revamp, and perhaps even a reboot of trade finance. And I think we're seeing a bit of that with some of the banks. So you get someone like SocGen moving their book away to Hong Kong. Does that really make too much of a difference to Singapore? I don't think so. But what really stood out for me was ABN AMRO's move away from commodity financing altogether. There could be many different reasons for it. I think we only see the superficial reasons, which is the recent events that have gone about in Singapore. I think this creates an unwanted trend in the financing world. I think there would be a crunch in liquidity. And if anything that we've learned from 2020 is that once liquidity gets threatened, we get to see some very ugly sides to trade finance and to commodities trading.
Right, thanks. And I know this is being characterized as a Singapore problem, because that's where a lot of these issues have been concentrated. But in your view, this is a kind of a broader commodities trading problem, right?
Correct. I think so. I think everyone likes to think it's a Singapore problem, and I'm going to fly the flag as a Singaporean, saying that this is a commodities problem rather than a Singapore problem. It is an issue of competing interests in a case of actually having to want to do business and take on certain risks that banks and lenders shouldn't have done. There is definitely culpability on all sides, I would say, but I wouldn't go as far to say this is a single problem. I think this is a case of having this is a worldwide problem, and this is a commodities problem.
That's great, thank you. So I think it probably makes sense to spend some time looking at the kind of conditions that led to banks being left with these kinds of exposures to commodities traders. Natalia, I wondered maybe if you could talk a bit around the due diligence processes, maybe the approach to liquidity on behalf of the banks that could have led to some of what we've seen over the last few months.
Right, thank you very much for the question. In my opinion, and from what I read in the public sources about how the situation unveiled, some of the activities that were exercised by these companies are very difficult to detect by a bank. So, for example, a trading company will not report if they make a purchase of a cargo at a profit or at a loss. You may not know that if you are funding a transaction. So sometimes in the letters of credit, there could be fluctuation clauses that are reflecting the market price and volatility. And even in that case, sometimes the whole price formula is not disclosed. So there will be only the index which is disclosed to the bank, because the traders are not really very keen to disclose sensitive information. And also, for example, if you are buying a cargo back with a loss, there could be a legitimate reason for that, because, for example, you manage an exposure on your counterparty. So, for example, you would like to quit an agreement and you would like to decrease the exposure as much as possible because you need to terminate and to minimize your losses. So not everything what you could see there is necessarily an immediate red flag. But if it comes to double financing, of course, without a proper technology and so very deep checks, it's very difficult to detect that if the company is especially big and work with 25, 30 banks. In this particular case, in your lending agreements, you would specify that the company does represent that it's basically acting according to all laws and there are no breaches of any warranties of obligations. So there's an element of trust. In terms of the due diligence, KYC, anti-money laundering, of course, there are very strict procedures across the banking community. And so they are probably being tighter and tighter. So I'm now doing a lot of reading about financial crimes because I'm prepping for a certificate in anti-money laundering. But again, some of the activities should be put in the context. Generally, my kind of impression that the major problem on the banking side, that there's too much reliance recently on the third-party reports, and some banks delegate a lot of their activities that should be actually within the banking system. For example, checking security. That was one of the problems that appeared during the Hinleon and other cases when the bank decided to claim the security, there was nothing in the tank, in the storage. When I was younger, I was basically going myself to check the security that the bank took as a pledge from the companies that we were lending. It was my banking days. And I think that so this activity is less and less exercised now by the banks. Again, so probably the solution could be in the technology, I don't know, drones flying above the tanks or something a bit more sophisticated. But as I said, so it's a combination of various factors. And unfortunately, I think that so the banks were struck by many of them at once.
Right, thanks. Raj, I wondered if I could ask you a kind of a follow-up question to that. In a lot of these cases, we saw descriptions of trades which can be perfectly legitimate back-to-back trades, where a trading company will purchase cargo and immediately sell it onto another, and a lot of that, as I understand it, is to generate liquidity and to generate working capital. Do you think there's an issue here around short-termism when it comes to generating liquidity within the sector?
I think that's a very interesting question. And I think that if we look at the approach from all sides of the transaction, it's very much a 20th century approach in a 21st century world. So rather than relying on technology which actually exists and can solve a problem, people are looking for other ways in which to resolve an issue. So, for example, they'll focus on the wrong metrics and then double down on the findings of those metrics. And it's a classic case of Goodhart's law. You know, the more you observe something, the more it goes out of control. So I think that in terms of generating liquidity, you can't blame the traders because this is the mechanism they saw. The private sector took advantage of it. And I think that the issue actually rests with the banks in taking a 20th and even 19th century approach to in the 21st century and not relying on technology enough to solve this issue.
Okay, thank you. Rob, I wondered if I could put the same kind of question to you, but also add on whether actions taken by insurers have an impact on demand for liquidity among banks and among traders.
Sure, thanks, John. Look, I suppose kind of the the political risk and structured credit insurance market, which I operate within, is there to, I suppose, act as a alternative distribution channel for banks looking to sell down risk rather than selling to other banks in the secondary market. So, you know, a lot of insurers are partnering with banks, working quite closely with banks to take on the risk. And again, I suppose they do place quite a lot of reliance in the actual bank process, which kind of, you know, the bank goes through when assessing these credit risks. I think the market had been hit quite hard in 2008, 2009, and then again in 2015, 16 during the commodity downturn. So I think, you know, a number of insurers were becoming a lot more selective around credit risk, assessing credit risk on a kind of individual basis a lot more carefully, probably for trading companies looking really at the kind of first and second tier traders and avoiding traders much lower than that. And so therefore, you know, I think also there's been a bit of a move towards some of the more medium to long-term business. So looking at, you know, structured transactions like asset-backed finance, project finance, even looking at non-trade related lending, which is also to higher rated counterparties. So I think the market perhaps hasn't been impacted as much by some of the recent losses as perhaps it may have been, you know, 5 or 10 years ago. But again, the names that have obviously had issues are ones that were probably considered a few years ago as being well-known, well-regarded names, and therefore I think, you know, this has caught everyone off guard. And I think going back to Natalia's point, it was just a bit of a culmination of a number of different factors in one go that has kind of impacted, you know, banks maybe didn't see coming, the insurance market perhaps didn't see coming, but again, I suppose it obviously requires everyone to maybe take a step back and have a look at the situation in a bit more detail, I suppose. I mean, coming back to your point about what, you know, do actions taken by insurers can have an impact on demand for liquidity? I mean, I suppose insurers do have to be a bit careful in some ways, because sometimes that is being provided to banks, to traders, is actually effectively making these transactions possible, making these trades possible. And so sometimes where you may see a loss on one counterparty, if you take immediate actions or rash actions and start cancelling limits or declining to renew policies entirely, it can actually cause losses. And we have actually seen in the past, you know, insurers cancelling limits or refusing to renew policies kind of outright does actually then result in a loss, and the insurer then gets a bit upset when the loss happens, but they don't quite realize that maybe if you want to kind of get out, you will wind it down slowly but surely rather than kind of taking a very drastic action. So I think there's also in some ways the insurance market needs to be a bit more careful about how it approaches some of these situations once it's into the mix, so to speak.
It is a bit slippery though, Rob, because the banks, sometimes the borrowers, the traders would say the same thing of the banks. They sort of say, well, it's going, if they kept lending, all of this would work out fine. And for them to even say that, I find that a startling position for a borrower to say that if the bank kept lending, I would have made the money back and I would have paid them off. And that is at the heart of the problem over here, because everyone is chasing liquidity. It's short term. And unfortunately, insurance is a means to that end. So it's a challenging market for the insurers in particular, I think.
Sure. I mean, I think it kind of goes back to the question, as you say, like, if the banks were under lots of pressure to lend because of the competition, then again, were the processes being followed quite as closely as they perhaps should have been? I mean, I think we've seen, perhaps not with some of the Singapore incidents, but we've certainly seen stuff in China in recent months where there was so many banks who were lending to it. The facilities were so large, and there was a lot of kind of competition to be an MLA on a facility. Were the banks being perhaps quite as diligent in their processes as not? That's a question I'm not 100% sure on, but I suppose it kind of leads into or comes back to your point, I suppose, in some ways.
Correct. It's a race. It's a race for business, but I think people don't realize it's the race to the bottom.
Yeah.
Actually, on that point, Baldev, I know you've written around the use of letters of indemnity in this context, and when you do go through the court documents relating to some of these cases, very often the banks relied on letters of indemnity in order to underpin paying out for these transactions. Do you think there are some issues there that the banks could do with looking at?
Correct. I think so. That's very specific to the oil trade in particular, because the oil trade sort of engages in a payment LOI, a payment letter of indemnity, which you will often find in no other type of commodity, just specific to oil. But the underlying issue over there is that in this game of smoke and mirrors, the art is to keep the BL away out of sight. So the reason why double financing can happen is because the BL goes through hands, number one, number two, number three, onto 10 different actors. And when we sort of investigate trade fraud, we're looking at where the BL goes. And that's where the magic happens for some of these traders. The BL disappears. Now, why is that relevant to a letter of indemnity? I think the letter of indemnity is effectively saying, don't worry about the BL. Pay me first. I'll sort you out with the BL later. What that means is that the BL, once again, is in circulation. And think of the BL as money. That's something you can go around and monetize 10 times over to 10 different banks, so that by the time it comes around to paying, you are in liquidity. And I think that's the biggest problem with trade finance now, is transparency and visibility over the BL. And the only way around it, and Raj can correct me if I'm wrong, but the only way around it is to have a central registry, is to sort of have a mechanism to control the BL. The trust receipt function used in banks, as Raj said, is a 20th century mechanism. It doesn't work anymore.
Yeah, I think that's a very relevant point, and I think we've actually gone a step further than that in terms of a central registry. We actually don't need a central registry at the moment. Blockchain, and I know there's a lot of hype about blockchain, but this is actually one of the relevant use cases on blockchain, because you're able to have a decentralized register. One of the issues on a central registry is it's open to hacking, it's open to fraud. There's issues on data, on privacy, on commercial security, GDPR, etc., etc. What blockchain does, and the technology has been around, and we've got several applications on this to stop double financing on invoices and warehouse receipts and so on, is that it actually creates a fingerprint of a BL of an invoice that rests on the blockchain, and any actor, anybody looking to perform a transaction on that document, can actually use an API to ping and check that fingerprint and see what the state is, whether it's been financed by another party in the chain. So that technology actually exists, and it's very deployable. The issue is that there has been resistance in adopting this technology. on the financier side. Number one, because I think that there's a reluctance to change from the 19th, I'd even say it's a 19th century method of operating. 20th century gives too much credit, I think, in terms of how this thing evolves. So there's internal resistance in terms of culture. But what we've seen, I think, with this whole COVID situation, is that there is an increased willingness to operate virtually, and we're all here today demonstrating this, and an increased reliance on technology. So I'm hoping that over the next 6 months, we'll see increased willingness in the culture of these financial institutions to adopt new technology and to try and alleviate some of these problems moving forward. And I think that the traders will actually be happy to adopt this, because if it means more liquidity for them, then why not?
I may jump in and just to make a comment about this kind of electronic solutions. I think that when I speak to banks, and so I enjoy connections with more than 30 banks around the globe, I think that the willingness to adopt technology is there, but there are some legal issues, especially if you operate internationally. So, for example, bill of exchange is not recognized. The electronic bill of exchange is not recognized across the globe, where the situation with electronic bill of lading is a bit better. But even, for example, if you have electronic bill of lading on Valera, so the moment you print it out to convert it into paper-based form, so there's a change of date, and then that can create a problem if you operate within the LC environment. So there are some unresolved issues, and that's why the bank legal teams probably are still trying to understand so the full scope of risks that they will be dealing with if they change to electronic version of communication completely. And also, I would like probably to ask a question about kind of implementation of this technology, because we all kind of read in the news that the new technology normally is introduced layer upon layer on the old one, which creates a lot of glitches. And so every company facing a question if you need to throw all your technology away and to buy a new one, which could be a costly exercise, or you're doing this layer upon layer upon layer upon layer, so on upgrades, which also kind of creates problems. So you always try to find a balance. So I wouldn't say that if you are a corporate or a bank, it's a very easy decision to make. And I've been on the corporate side making a decision either to buy an application for a bank office in the company or to create my own. And I ended up with designing my own because it was more compatible with all the systems that the company had in place at that particular moment. So it's I think that it's not unwillingness, it's just the complexity of this task.
I actually disagree with that. I think that there are two points here. Number one is, if we look at the commercial imperative is to actually de-risk the transaction. So if you're able to do that and then carry on with your processes, then that's an easy way of doing it, rather than saying you have to rip out all your technology and move forward from there. So, for example, the use of APIs is very relevant here, because you can have a technology solution, you can then ping an API, get the information you need, and then come back to your workflow and move on. So that technology very much exists. I think on the legal side is where the problem surfaces, because obviously, again, it's a question of catching up with the 21st century. If you are able to understand what's going on the commercial side, then the legal side can actually follow the existing workflow. And you can use the technology to say, okay, look, this is just a reference. It's an informational source in order for us to be sure that this transaction is actually not fraudulent, and we can use it to de-risk that. So there's ways of working in parallel in order to solve this problem. And I'll give you an example. So we demoed an application of ours called Invoice Check to stop the double financing of invoices. And it was to a meeting of about 60 banks. And we demoed how it all worked on the blockchain, and we actually showed it live, et cetera, et cetera. And all the banks wanted to actually license the technology, but for their own internal use. They didn't want anybody else to use it. And that defeated the object of the exercise. So I do think that there is a level of understanding that needs to be gone through. And then to understand that, okay, the commercial side in terms of actually pinging an API to check a transaction is different from the legal side, which can, if need be, continue in the offline environment. So there are ways around it. But there has to be the willingness to say, okay, look, how do we actually move forward and solve this problem?
But you gave fantastic example of what just now talking about how the banks would like to license it to use only for their purposes. So
Right.
do you think that so you need probably to pitch it to a regulator for a regulator to disburse it as a mandatory part of their routine?
Yeah, absolutely. So we're having these conversations now, and I think that the relevance of blockchain is that, again, it's decentralized. So the regulator can run their own node. Each of the banks can run their own node if they want, or they can run a managed node, for example. So the technology is very much there, and it's not a barrier. It's more like, okay, we know this problem exists. The technology is there. Now let's all put our heads together and see how we can adopt it to move forward. And that's the missing link at this moment in time. But I'm hoping that, there's nothing quite like massive losses in red ink to accelerate a decision-making process. So I'm hoping that by the time everyone does the sums on what's happened in the commodity space, that they realize it's cheaper to actually implement a solution like this than to face this again in the next cycle, next 5-8 years, something like that.
I'm hoping with you.
This notion that Valdev brought up of having some kind of central registry that the banks could use for due diligence purposes, whether or not that were irrespective of the technology used, is that something that you think? I'll start with Natalia here, and then maybe go to Rob. Is that something, Natalia, that you think could make a significant difference when banks are making these kinds of decisions, whether or not to fund a trade?
Central registry. Well, like we just discussed, central registry also kind of poses some issues. Especially, I would be kind of willing to understand who will manage this central registry and what would be the technology criteria, where will be the data stored. Because again, so when I was doing my application in my last corporate role, there were a lot of questions from my IT, so about the programs that we could potentially buy, where the data is stored, who is managing it, so what are the legislation and jurisdictions engaged, so all sorts of questions. I actually very much kind of up for blockchain and new technologies rather than the central registry. The issue is how you operate with many platforms that are available, especially if we're talking about double financing, but that's for IT guys to resolve. But the more transparent, the better, definitely. I agree with that.
Rob, is there anything you'd like to add?
Look, I do think that blockchain does potentially, offer lots of opportunities for kind of, certainly, and again, from insurance perspective, I think there is, I think insurers will probably welcome the ability to have some sort of, centralized database and blockchain solution that allows kind of greater control over, the trade finance flows, and whether you can, and being able to check whether they are, kind of legitimate, etc. I think the challenge, well, look, I suppose there's a lot of talk about blockchain, and I think going back to Raj's point, I think it's getting that kind of meeting of minds, or kind of willingness of all participants in the actual ecosystem to actually engage and really kind of adopt blockchain. Because I think at the moment, people still aren't quite sure about how it all works and how it goes forward. And I think also the insurance market is probably slightly more archaic than some of the other industries. So I think there has been lots of movement in the direction of data and kind of having greater kind of visibility on that sort of thing in recent years, and I think there are a number of insurers who are pretty good on data and these sort of kind of platforms. But I think there needs to be more done across the board to get that adoption of kind of blockchain solutions to which hopefully will improve the processes in the future.
John, if I could add, actually, blockchain is the gold standard for what you want to get to. I'm not even asking for that. I'm actually suggesting start with the lowest point. In Singapore, we have something called ACRA, the company's registry, you see. So if you want to lend, you go to ACRA and then you see, okay, borrower A has got X amount of charges listed. And then you get to see, you won't get to see the values and so on, but you get to see that a charge has been made. Now, the reason why double pledging occurs with BLs is because BLs, pledging, just by its concept, pledge means you have possession of the goods. That's why you don't need to declare it to the rest of the world. It is with you. The fact that it's with you is a sign of ownership, is a sign of possession. The reason why you don't have to put it onto ACRA is because it is meant to be, you are meant to be in control of the goods. Now, this works if you're talking about a tangible item, talking about cars or something, but over here, we have a BL that decouples from the actual physical goods itself. So the BL floating around in one system, the goods are moving in another system. And in this game of smoke and mirrors, I only need to make you focus your eyes on one hand while I'm moving it around in the other hand. And I think that's where my idea of a central registry, it wasn't even my idea, but at the very least, for banks to understand what sort of leverage is being taken, what sort of goods are being financed, what sort of level of trade finance is being done. They cannot be at the mercy of the borrower to self-declare. There has to be a registry where they go and they can get some basic information. After that, it's due diligence, how much of it they want to go into, it's up to them. But our starting point in today's world, which is quite shocking, is that it's a blind world. No one can tell whether BL's been pledged or not.
Raj, can I ask you whether this might be a stupid question, but if you did end up in a world where you had banks and even insurers, traders operating, might be on a single platform or might be on different technological platforms linked by APIs, as you described, hypothetically, could a bank and a trader just step outside that platform, outside that technological framework, and double financing is immediately possible again?
Well, the power of the platform depends on the amount of data you get coming into it. So say, for example, if a regulator mandated that all banks had to sign up for this API that tracks invoices, BLs, warehouse receipts, etc., it would be very difficult for a bank to step out of that if it had been mandated to be part of it by a regulator. If it was, say, for example, a fintech platform, and we've seen this actually in Singapore, where a company has a charge registered in ACRA on all their receivables, but then they've taken the same receivable and gone to 3 or 4 fintech platforms to basically get the financing for that. So it is something that a regulator could very easily solve just by saying, this is it, this is what you guys have to do, and this is part of your operating procedures as part of being licensed to operate in a jurisdiction. Alternatively, there are industry bodies which, so for example, fintech associations, factoring associations, etc., which can make it voluntary for their members to use it. But obviously that's less comprehensive than having a regulator do it. We have seen a lot of willingness from the fintech sector to do this because obviously it provides some sort of validation for their investors to say that, okay, we are taking steps to stop double financing of invoices. It's not perfect by any means, but it's a step in the right direction, and it's better than doing nothing. So that's the current situation at the moment.
Right.
But we have a lot of regulators and a lot of markets, and traders operate internationally. So how we can make sure that so something which happens in Germany is also applicable to Singapore and vice versa? So just to give an example from my last corporate role, the company was registered in the UK, but the financing was obtained from banks across the globe, and the banks were registered in the US, all sorts of European jurisdiction, continental ones, Singapore. So there were a lot of regulators involved, and hence the complexity. If you are a smaller trading house and you're dealing with a bank within the same jurisdiction, yes, that's definitely a solution. But for big companies that are dealing across the globe, I believe that it's a bit more difficult.
I think that there's actually quite a simple answer to that question, because if you look at the transaction itself, which I think is actually missing in terms of what banks do. Banks are very good at doing KYC, AML, looking at the financials and then saying, yes, we're going to allow company X to have X million of dollars to trade, and that's it. And then when you get into the transaction level specifics, that's when things start to become opaque, because then you have this ego around where the ball's just exchanging hands from one party to another at the speed of light, quite frankly. I think that if you have one registry, say one registry in a jurisdiction, any party in another jurisdiction can very easily pick a registry to see, okay, well, this is what's been done there. Although we're not mandated to use it in our jurisdiction, we can see what's happening somewhere else. And that's actually better than doing nothing and just having blind trust in parties to move forward. So I think as long as one jurisdiction or one entity or one association decides that, okay, this is what we're going to do, then the API becomes available for everybody else globally.
What about unsecured lending?
Unsecured lending. Well, again, it depends very much. It depends very much on whether people want to use an API or not for that, and to actually say that, okay, we're actually going to, even though it's unsecured, we are still going to register the transaction on a registry that exists.
Well, that's interesting concept. If you have an unsecured lending,
I just want to make one point, is that if you have a lending of any type, you can actually force, for lack of a better term, the borrower to use certain technologies, because you say, look, you either do this or you're not going to get the money, whether it's secured or unsecured. And we've seen this in our operations as well.
Yeah, just for the last few minutes, I wondered if we could take a look forward and maybe talk about some potential lessons learned here. Not so much in terms of technological adoption, but in terms of what banking industry participants, insurance industry, commodity traders could potentially do differently in the immediate term. Rob, is it okay if I start with you on that one?
Sure. I mean, look, I suppose, speaking with some insurers kind of in the aftermath of kind of recent, some of the things that have been highlighted as, looking at when you're seeing transactions where you've got a trader selling to another trader, I think that's something that will probably be the insurance market will be looking to avoid going forward, without a kind of clear end buyer who has a requirement for some goods and is planning to do something with those goods, and therefore there will be some some money coming back at some point because they're going to process and on-sell those goods. I think there's been a lot of kind of trader to trader to trader to trader, and not really clear as to what the actual whether there's a true trade going on effectively. I think that's something that insurers will be quite kind of cautious on going forwards. I think there's, I think we talked about commodities a lot today, but I think trade finance can involve other industries, other areas. So I think there'll be probably a focus on trade finance outside of commodities, which are probably a bit more kind of open to fraud. I think also, I think insurers will probably be looking at doing enhanced due diligence on the bank's processes as to how they're going about kind of approving transactions, and probably to Raj's point, in a bit more detail as to the actual individual transactions being carried out. And I think they'll also, where you've got a kind of trade finance facility that has multiple different instruments available and multiple different tranches, I think there'll probably be underwriters will be looking to put some caps on the extent of a facility that can be used for a particular type of instrument. I think sometimes there's been instances where, you know, there's a facility has been fully used under one type of instrument, going back to the kind of LOI point, which is probably not what was the intention in the first place. Obviously, there's a willingness or an ability for that to be done and the bank to do that, but I think there'll probably be some limitations put on that by insurers going forward, perhaps.
Great. If I could put the same question over to Baldev around potential lessons learned here. And maybe is it worth looking at whether there's a difference if you're an SME trader compared to if you're one of the kind of the international big players?
I think there's a long list of lessons to be learned, but looking forward, what are we going to see? We're going to see less liquidity in the market. It'll be harder to get financing. It'll be harder to get insurance. The SMEs will naturally be the first to suffer with that. There will be a revamp, a reculling of the market, and that's not necessarily a bad thing. I think you can focus. There will be a metamorphosis in trade finance, particularly in Singapore, largely because Singapore attracts a lot of the SME traders into this market. And I think it's for the better. I think, as Raj mentioned as well, people are more, the appetite is finally there to take on blockchain technology when there wasn't before. Ideas of central registry, all these ideas we've been discussing before, EBLs and so on, have been around for years. And I think now you finally have some appetite to actually go and adopt and implement it. So I think I'm actually a lot more hopeful than what the press puts out into the future of trade finance.
Great, thanks. And Natalia?
I fully echo so what my fellow speakers said. Fully agree with what Baldev just mentioned. So my kind of observation that I made, I think that banks should retain experienced personnel more, and if they desire to hire younger people, so they need to invest a lot into training, because trade finance is highly technical area. If you read a book about LCs, even if it's technically oriented, it doesn't mean that you're a specialist. So in trade finance, people need 20, 25 years of experience to kind of have a gut feeling that something is incorrect in the transaction. And with all these redundancies that I see now across the industry, I'm really sad. I think that the industry is losing expertise, and I hope that it will be reversed.
Right. Okay. So in terms of lessons learned, it's about retaining talent and ensuring there is a kind of pipeline of talent still coming through.
Absolutely.
Okay. And finally, Raj, same question to you. What would you say are the biggest lessons to be learned from all this?
I think finally that it's time to, as Baldev mentioned, to look at a wholesale change in how trade finance due diligence is conducted, to adopt the technologies that are there, look at things like IoT and, as Natalia mentioned, drones, etc. This is obviously moving forward, but we have to start with the basics. The basics are we know what the problems that this crisis has highlighted, fix those, and then continue to adopt new technologies to move into the future, and then retrain the talent that's coming through to actively be comfortable in working with these technologies.
That's great. Okay, so there are short-term steps companies can take in terms of technology, and then there are longer-term goals that they can work towards.
Precisely.
Excellent. Okay, well, thanks very much. I'm afraid we're out of time. I'd just like to say a huge thank you to all of our panelists, to Natalia, Baldev, Rob, and Raj, and thanks again to all of you who've tuned into this event. For those of you who are doing the GTR challenge and hoping to win an Apple Watch, we do have a secret code word for this session. If you've made it this far, you can redeem points towards the GTR challenge with the word de-risk. So all one word, no hyphen, D-E-R-I-S-K. Okay, so that's all from me. Thanks again, and goodbye.